No one knows when a recession will hit, and if the smartest economies in the world were able to predict the booms and busts of the market, they would be billionaires. Yet they're still employed by other companies making predictions just like the rest of us. So it is impossible to know for sure when the recession will hit. However, with inflation at a 40-year high, supply chain issues, the Russia-Ukraine war causing instability in the global markets, and labor shortages, the odds of a recession are increasing. But that shouldn't be a cause of stress, only a sign to shift your attitude towards money and be more responsible in managing your wallet. Hi, my name is Neera and I'm a financial analyst. I talk about personal finance and investment and teach you how to make money and grow it exponentially. If you're interested in this topic, consider subscribing, as this will help the channel grow and impact more people. While you can't control what's happening in the market, you can take actionable steps to prepare yourself and your finances from a negative impact. The good news is that we're not there yet, and there is still time to prepare for the inevitable. And if it doesn't happen, well, then even better. It'll never hurt to tidy up your finances and protect your hard-earned money. In this video, I will walk you through several ways you can recession-proof your money. Recessions occur when a country's GDP, which measures the monetary value of all economic activity of the country, stops growing and starts to shrink for 2 consecutive quarters. Unfortunately, when a recession begins, the first group of people to get hit by the negative outcome are the middle class and hourly workers through furloughs, hours cut back, pay cuts, and losing your steady salary to high inflation. Here's how you can prepare for a recession. The first step is to map out your debts, assets, income streams, and expenses. You'll need to understand how your assets are allocated across illiquid assets like real estate, stocks, savings or money market accounts, and cash. This will help you understand your exposure and the risks you have when the market goes south. Also, you have to understand cash and savings account should have the majority of your assets when economic conditions don't look good. Cash is king when economic conditions look bad. So it is a good idea to have a savings account open with a good interest rate. You wouldn't want to sell your stocks or real estate at a discounted price just because you didn't plan ahead for bad times and run out of cash quickly. Second, extending on the first step, you would want to pay out any outstanding high-interest debt. This is the costliest expense and usually increases during a financial downturn. The average annual percentage rate on a credit card is around 16% during the good times, which can cost you thousands of dollars if you don't pay them off on time. Moreover, for avoiding any late fees and interest charges, you can use that money to increase your high-yield savings account balance, where the bank pays you interest. And if you don't have any debt at the moment, don't even think about taking any on. I see so many videos that talk about using other people's money to grow your real estate investment portfolio. But guess what? That's not free money. You will have to pay it back, and usually with high interest. And if market is not favorable, your losses will explode and eat up all of your savings. Assess your personal financial situation before taking any advice. Number 3, you'd want to start cutting on expenses. There are numerous apps that allow you to track your budget and see where you spend most. Generally, it is advisable to only spend 30% of your after-tax income on items that you can live without. With rising prices, you would want to cut down on non-essential expenses like dining out, memberships, and streaming services you don't really use. Renovations that you've been wanting to do, trust me, there'll be a better time to make those happen. Budgeting may sound like a boring and tedious task, but it's the most important way to stay in charge of your wallet and grow your wealth. The fourth thing you can do to prepare for a recession is build up your rainy day fund. Recession or not, you should already have an emergency fund that should cover 6 months worth of expenses. So to prepare for a recession, increasing it to 8 to 9 months wouldn't hurt. Start small, saving around 20% of your after-tax income. It might feel slow at first, but over time, you will reach your desired number. The best way is to automate these deductions from your bank account and stick to your original plan, no matter the short-term temptation. Also, it is important to remember that you should keep your emergency fund in a liquid account like high-yield savings account or money market account to easily access it when you need it. It is essential that you shop around for the banks that offer the best interest rates to maximize your return. Emergency funds are not only beneficial for your financial health, but for your mental and emotional health as well. It gives you peace of mind and less stress if you know that you'll be able to get through any economic setback. Before we get into the next point, make sure to like and subscribe to my channel to get more helpful videos about personal finance and investing strategies. Your support helps the channel and others who would also find this information useful. Next, I want to focus on your investments. Let me point this out. Recessions are a golden opportunity to buy, not to sell. The worst thing you can do in this market is panic sell stocks or real estate unless you absolutely need to. When COVID-19 hit, a lot of real estate and stock investors sold their assets in panic, probably afraid that it will be similar to 2008 crisis. However, the biggest boom in the market followed, and not only did they sell at a discount, but also left a lot of money on the table. Of course, it is easy to say in hindsight that it turned out the way it did. However, the point here is that you should never change your long-term strategy because of short-term swings in the market. If you followed the above-mentioned steps and still have cash left, invest it in the stock market and decrease your average cost per share. Buying stocks at a cheap, discounted price have huge upside, and most of those deals you can easily spot during a recession. For instance, would you sell your PS5 if it were at a discounted price? Of course not. First thing that'll probably come to your mind is to buy more and wait until the discount is over so that you can sell them back at a nice profit. However, you must be cautious in what you invest. Know the difference between a discounted company and a worthless one. Some companies don't make it through a recession, while some come out victorious with a more aggressive growth strategy. You can do a little research to find a good buy, or just put your money in index funds that tracks the market. Investing in real estate is also a good idea, and it is during these tough times that you can find a good deal when sellers are more motivated to sell. You're more prepared and financially stable, and given the market, you have more negotiating power. Check out my video on financial instruments you can invest in to have a better idea. I share the advantages and risks of each type of investment to make it easier for you to decide which one better suits your needs. Tip number 6 is probably the most obvious one. Invest in yourself. Improve your understanding of basic economics and finance that affect your daily life. This will help you be less reactive to the negative news that you watch daily. Comments of your panicking social circle about how bad the economy is and that they're selling everything. Build resilience against market downturns, ignore the noise, and see everything in a better opportunistic perspective. Of course, it is easier said than done, but with education and practice, you will build necessary skills to follow through. That's the reason I started this channel, to increase financial literacy and empower retail investors to make smart decisions that are rational rather than emotional. If you like this video, leave us a thumbs up, subscribe to the channel, and make sure you turn on the notifications to never miss out. Check out my other videos on the channel for other money-making ideas you don't want to miss out on. As always, thanks for watching, and until next time.